You point out that most are assuming at some point this is going to be a buy on dips opportunity, and yet you point out that you aren't so sure. Why?
Well, I think this is a part of the renormalization process. I don't think this process has been over. If you think about it, over the last couple of years, the world economy has been lukewarm, anemic, whatever you want to call it, and yet we have had a great stock market. Right now, I think we're into some kind of a mini economic boom, and that basically means that interest rates, bond yields, and everything else will have to adjust higher. As a result, the earnings, the discounted value of earnings, have fallen. So this is a part of the adjustment process you would expect, because when you move interest rates from very low level to a higher level, and you're going to see a massive adjustment in terms of PE ratios, in terms of asset prices. So we're just at the beginning of this. Don't forget that we only have 2.8% bond yields. I think the bond yield is going to go to 3.5%, maybe eventually to 4%. So we got a long way to go here.
A long way to go. So you've got good earnings as a result of this mini economic boom, as you point out, but higher rates across the curve, which could depress share prices. That's in the United States. We're just flashing some facts here that the emerging market stocks index, the MSCI EM index, has now entered a correction, down 10% from its peak. Does that apply to the EM equities world as well?
Absolutely. Well, the story here is a very different one. If you look at emerging markets, the interest rate level there actually have never fallen as low as what we saw in G7. So we're talking about basically zero rate in the United States, in Europe, and in Japan, whereas if you look at interest rates across emerging markets, they are still quite high. So I don't think we have the same task in terms of a renormalization in the emerging markets versus in the G7 world. So that's the first point. The second point is I do think this thing, especially when you look at the relative performance between EM and the United States S&P 500. This thing goes by 10-year cycles. So last time the EM really outperformed the S&P was 2000, in decades of 2000s. Previous decade, actually, emerging market really got hammered. I think this time going forward, we're going to have a emerging markets turn again. So I think this is the sort of a long-term view.
Explain to us specifically the relationship between a higher rate environment in the U.S. and the prospects for EM. Historically, I think, classically speaking, higher rates not considered good for EM, but then you also hear people say, yeah, but that's kind of broken down, it's not as sensitive. What is the link right now?
Well, think about this. EM currencies got hammered in 2014 and 15. They collapsed. Whereas the dollar was very strong. Right now, the whole dynamic has been reversed. In other words, the U.S. dollar has starting to weaken, whereas EM currencies start to go up. So once EM currencies start to go up, EM interest rates are beginning to fall. Actually, you can see that in Brazil. You can see that in many Latin countries. When interest rates start to fall, that gives a good reason for stock market there to outperform everybody else. So I think this is really a sort of vicious circle turning virtuous one. So that's why I think if you look at the dynamics between currency and the interest rates, that's why I think the case for EM become very strong.